Disaster and risk modeling has been started by the insurance industry decades ago, but this has been really recently in the last decade or so that emerging markets and developing economies have had a great interest in understanding better what the opportunities are. We, with the World Bank, have been working with risk modeling firms, and in particularly we've been developing catastrophic models, particularly, for example, in the South Pacific. And we also have been promoting open public goods risk cat models, and amongst them, for example, the global earthquake model. And I think here the point is, while there are more and more models available, I think it's important to focus on the challenges for emerging markets to actually use these models, because the importance is not only having the models, but also how to have them inform financial decision-making. Governments usually are solicited or asked by private insurance or investment banks to use models for innovative financial solutions. However, the key challenge is having the tools and the institutional capacity to actually assess, first, how effective those tools are and how they fit in the government strategy, and also whether they are priced fairly. And that's exactly where our role comes in, because we're neutral advisors, can help increase that knowledge so that governments are more willing and able to use the services of the insurance industry. And maybe just to finalize, maybe to focus on what is needed to improve the understanding, access, and use of cat risk models. Because the challenges here, I'd say, are three. One is the models many times are complex, and therefore there is a bit the sense that they're black boxes. There is usually uncertainty regarding the results. And also, I think the fundamental point is many of these models are focused on estimates of losses of specific insurance portfolios, while for government, really what's important is to see what the losses could be for the economy as a whole. And I think the point of this is that I think there's a great opportunity for the insurance industry working with sovereign authorities and international financial institutions to build, to lower this knowledge gap, so that then innovative solutions can be used where insurance can be brought in. The World Bank has been working with many countries across the globe in developing public-private partnerships. And I think there's a few examples that I'd like to share with you. I think one is on the area of catastrophic risk pools. And there we have supported the creation of sovereign cat risk insurance pools, first in the Caribbean and then in the Pacific. And this delivered an aggregate coverage of about $650 million annually to 21 countries. We also have supported the Turkish catastrophic risk insurance facility, and then one also for Southern Europe and the Caucasus. I think we've done also quite innovative work in terms of customizing weather derivative strategies that link weather insurance to commodity risk hedging. So we did in 2014, working with the government of Uruguay, a large weather derivative contract, and also we supported the government of Mexico on developing a catastrophic risk bond. That actually, the importance of it is because we work with the insurance industry, particularly the reinsurance industry and investment banks, to actually develop a platform that now can be used by other countries, though in the case of Mexico was focused on earthquake and hurricane risk. And I think the key point in all these examples is that they were possible, they were successful exactly because they combine the market expertise of the insurance industry, a willingness by those countries to begin shifting from exposed financing of losses to ex-ante risk management, and our capacity to bring them in and sit them at the table as a neutral advisor.